Hey, family. It's your family CPA, Jasmine Young, and you're listening to the Talk Wealthy to Me podcast. Get you a black CPA. We out here. Hey, family. It's your family CPA back with another episode of Talk Wealthy to Me. And I'm so excited about today's episode. Today, we are going to be talking about real estate and the home buying process. And I am excited and honored to have with me mortgage loan officer, Miss Amber Thompson. Amber, how you doing?
Hey, Jazz. I'm doing pretty well. Thank you for having me. And how are you?
Absolutely. I'm doing well as well. Glad you could make it on the show. A lot of people are in the market for buying homes, and a lot of people don't know what that process looks like. Some people don't start because they don't know. So I feel like this episode, this conversation is very important, especially in the African American community, so that we can help people, become generationally wealthy through the area of real estate. So before we get into all of that, tell us a little bit about who you are and what you do.
Absolutely. Again, as you know, my name is Amber, and I am a mortgage loan originator, aka loan officer. Same difference. I've been in this industry for a little over 20 years. Started out in different aspects of this industry. Initially, I started out as a realtor back in the early 2000s. And it wasn't as fulfilling for me because I wanted to be able to impact people more on the financial literacy side of things and help people understand what does credit really means and what it means to you in the real estate world. And so moving in each sector, I stayed in the finance industry in reference to underwriting, processing. I've done it pretty much all sectors of it, to be honest with you. And so it led me to where I am today, being a loan officer. And being a loan officer, I'm on the front face, the front end. I'm the first point of contact before you can do a loan, unless you're spending cash to buy it. And then technically you really don't need me, right? But when you're looking to finance a home, you need me in order to do that. The first phase is making sure that your credit is worthy. And then we move into the other sectors of what else is required. So the first thing is always credit. And then employment goes hand in hand, right? The biggest thing is how many of us, grew up in that world or that generation where credit was taught. Owning a home, what it would take to own a home. A lot of us didn't grow up in a household where your parents probably owned their home. It was more so maybe renting or in apartments, right? So I'm here to help not just educate people on what financial literacy is, but help them also understand the variations of it, right? So when it comes to loan origination, the first key is to start. You have to start and see where you stand with your credit. Your credit is your resume. It determines a lot about a person, right? And a lot of us are afraid of what we see on our credit, or there are myths where they look at all these third-party sources like, Credit Karma, or they use their Wells Fargo. Every company, no matter what type of business it is, we use different scorecards. So when you're trying to get a mortgage, what you see on Credit Karma is not the same that you'll see when I pull your credit, right?
Absolutely.
So it's just helping people even understand that dynamic of credit and, helping you build and maintain strong credit is a challenge. That's probably one of the biggest things that I see and have seen in so many years of doing this, that it's not so much that people just have bad credit. They don't know how to maintain healthy credit, as well as establishing credit, where to apply. It makes a very big difference in this industry. But like I stated, I've been doing this for a very long time. I, on the front end, make sure I just help my people and people in general understand what credit is, how it ties into what you're trying to do, especially in the finance world. And then making sure you're not house poor, as well as having strong credit once we're going through the process and we're done. Right?
People don't know how being house poor is a real thing. Like, you go out and spend all this money to get this house, and you really can't afford it living check to check. just so you can have a mortgage. Like that's a real thing. So I'm glad you brought that up. Before we get too deep into the process and what it all looks like, let's talk a little bit about the market. You know, the pandemic hit, and now interest rates are higher than what we've seen in the past 3 years because the Federal Reserve rate was at 0%. So the interest rates were low during the pandemic, but now they're kind of adjusting, and we're quote unquote in an inflation, dealing with inflation and being in a recession. So should people at this time, should people be even considering buying a home? Like, is it a good time with the interest rates being what they are, or should people try to like wait it out?
You know, this is a very interesting topic, and we have so many different dialogues with this. Here's the thing: real estate been around before me and you were born. You think this is the first recession? You think this is the first spike in interest rates? Everything right now is on a rise, right? But have builders start building? Every time I turn and look, they're building something. Yes. Yeah, they're knocking down land to build. The thing is, these rates are not new rates to us who have been in this market. We've seen these rates before years ago, but you have to take into consideration, and I don't talk politics too much because everybody has an opinion when it comes to politics. Right. But I do feel certain things are put in place to throw us off of what's really going on in the government or with the government. Right. I still have people buying houses, refinancing, investing, and it's not stopping them. The rates are the rates. You can still get a good rate. What people don't educate you and tell you about is that your credit scores have a very big factor on your rate, absolutely, as well as the loan product and the stock market. All of those are factors. Now, a good portion of my clients, I'll be honest with you, at least probably about 90-95% of my clients, they buy down their rate. Okay. And what that means is we have rates that come in at what we call PAR, P-A-R. And I use that, I say, please, Aunt Rebecca, so that people can resonate with PAR, right? And when a rate comes in at PAR, it's 100%, meaning that it's no cost to you, it's no cost to me. If a rate comes under 100%, it's a cost to you, the buyer. If it comes in at 100% or over, it's a credit to you as the buyer. So what that means to you, you can get a rate for less than what you see the going rate is right now, but it may cost you. The challenge is how many people are financially in a position to pay for a rate, right? That's the challenge. I mean, I still have clients that have rates in the 5s. Now, granted, maybe not as low as the 4s and 3s like we've seen years ago, right? But I don't sell rates. I base rates off real time based off your live scenario in that moment, right? Now, granted, it depends on the situation, the scenario. I have clients that go with a higher rate just to offset having to spend extra money. But then the end goal for me and for them is to come back and refinance.
Absolutely. Right? I did the exact same thing.
It's what we need to do to get you in the home, but we're going to make sure that it's cost efficient for you so that you're not house poor for at least that first year. Right. That's where the refinances can come into play to help you. But most people don't speak on that. They don't know about it. When you hear refinance, they're like, oh no, I'm scared to do a refinance. These rates are too high. But if you're not educated on that and you're listening to the streets, then yes, that will be the perception that you have. And that's why we stay behind. Because we're not educated to know how certain things can work in your favor if you were to listen to the truth when it comes to your unique situation and not base it on the next person's experience. Right.
And that's something we see in the financial industry, especially in my CPA firm. I see it all the time. People like, well, why was this person able to get a $10,000 refund? Ma'am, sir, your situation is not their situation. You can't say, you know, well, why didn't I get this? Because you're not in the same situation. So I'm glad that you brought that up about people, you know, taking the information and basing it on their specific situation and not comparing it to other people. And also, too, listening to the right people, because one thing I found with our community is we will not read, we will not research, but we'll listen to the next person and this person. And they're not the people to listen to. If anything, listen to the people that are the professionals in that specific industry to get the information from. So I think that that's a big thing. Now, you talked a little bit about credit. and making sure that you're credit worthy. With the rates being what they are now, what should a person's credit score at a minimum be in order to, be in this process and possibly get a home?
So that's funny that you're bringing that up too. And I'm loving the dialogue. I'm loving the dynamics of these things. You can have a no score and get a house, but people don't know that, right? The trade-off is there are loan products for really everyone's situation. It just depends on the client. So what I mean by that, you have traditional loans, you have non-traditional. Traditional is the typical way that we go when you're doing an FHA, VA, conventional USDA loans, right? Those are loan products. Traditional, meaning that you have to have 2 years employment history, right? You have to have a 30-day pay stub. You have to have a 30 or 60-day bank statement, right? You have to, that's the traditional route. Well, the non-traditional, which is the non-QM, that's the offset, meaning that you can have a no score. You can have low scores. The trade-off is you have to have money. So you can get and purchase a loan going non-QM, non-traditional. If you don't specifically, if you, for instance, self-employed, you write everything off, tax returns don't support the income, you can do a bank statement loan, or you can do an asset depletion loan. You can do a loan in your business. All of those are factors and can work on the non-QM side, non-qualifying mortgages, which is non-traditional, but it costs money. That's the trade-off. So you look at it from this perspective. What would an investor gain by doing a loan with you when you don't have the traditional documents? What would be his trade-off? Money. Right. So if I'm going to give you a loan, what do I get in return from you? It's like interest. Right. You're going to pay me that extra in order for me to loan you this money. That's the trade-off. So credit scores, typically, if you're on a traditional loan, if we're doing traditional, I can work with anyone under 600, but the challenge is you're going to have a higher rate because your credit scores are low. And most of the time, if your credit scores are that low, your rate is high, that drives your debt to income ratios, DTI, up. If it drives your DTI up, it brings your buying power down.
Yep.
Okay. So ideally, I would prefer all my clients to be over 640, 660. Right. And believe it or not, really anyone that's in the 600 club, granted, it's a good score, but it's not where scores are more favorable in this market now. Even a 700 score doesn't get as much favor as you would think. Most people have, hey, I got a 700 score. But believe it or not, it's not that much of a difference if it's somebody with a 680. The scores are almost, they kind of neck and neck when it comes to your rate, right? Now, that's on the traditional side. When we're getting into the non-traditional side, your credit scores need to be a little stronger. Because the rates and all of that is higher on the non-traditional because that's a risk.
It's risk association.
Absolutely. And so with that being stated, the higher the scores, the better for one. And the better when it comes to your rate as well. And then in addition to it determines how much you have to put down. So on the non-QM side, minimum down is going to be 10%, depending on your scores. But you're going to be in a bracket between 10 and 20% when you're going non-QM, non-qualifying mortgages or non-traditional, right? But how likely do people have 10% to put down?
Not likely, especially after a pandemic, not likely at all.
So it works for people who have money, foreign national, people who come to the States or what have you that don't have 2 years of employment history. What do they have? They may have money, right? People who write everything off on their taxes, they may have bank statements, but at the end of the day, they have money. So it's room for pretty much any type of individual. It just depends on that scenario for the individual. Now, if you don't have money and you have low scores, then you need to work on your credit. That's just the bottom line. That's the realistic factor of it. Like, seriously, you just need to work on your credit. And in the midst of working on your credit, we have to get into a habit of making it a lifestyle to save. That's something else that we as a race of people, we don't do. And I understand sometimes it's hard. But when we're dealing with a community that competition is a factor, everybody in a sense want to appear this persona that you're living a lifestyle, but everything
that
else is
not really living.
So when we can get past that mentality, right, I guarantee you we'll see more of a shift in our demographic of people when we're not trying to compete with our brother and sister, whether they're up or down. You'll be surprised some of the people that appear, to have all these things, they're struggling behind the scenes.
Absolutely. some of the most notable people that you think have houses.
Influential people.
Yeah,
Absolutely.
they come
and we see it every day.
it's like,
yeah. So it's just really helping go back to the drawing board. Go back to the basis of credit, financial literacy. When you have your credit in order, it's your resume. It can get you in rooms and doors that a lot of, things can't. But it goes hand in hand too with money. You still need to save. And that's another thing that, I know it's hard for a good percentage of us to save because it wasn't drilled in us to save. Most people live paycheck to paycheck.
Right.
But one thing that I do to all of my clients that I pre-approve, and I have recurring clients that have come back to me from 10, 15 years ago, they send their kids, the grandkids, I build their portfolios, I do their refinances, I have recurring clients. One thing that they can tell you, and if you Google me, you'll see my reviews and everything. I put everybody on a budget when I pre-approve them.
Absolutely.
When I look at your bank statement and I see your spending habit, if you're a face beater, a nail girl, a sneakerhead, a coffee, it's a done deal. But the end goal is once you cut some of those habits out and you see how much you save, it becomes a lifestyle. Mm-hmm. Now you feeling good about, oh my God, I'm really saving this kind of money. You look at your account and you feel good about, wow. Right. You know what I mean? Because it just takes that discipline shift to become a lifestyle. That's if you're serious about purchasing a home. So I do that purposely. And I explain this as well to all of my clients so that they understand, listen, the end goal for you is to what? Buy a house. And if you're serious about buying this house and you're tired of renting, you're going to do it what it takes.
Yes, ma'am. Absolutely. You're going to do what it takes to get in that home. Listen, absolutely. I'm loving this conversation, but I want to get into talking about after the credit is good, after we've, gotten our pre-approval letter and we're ready for the process and we're getting ready to go on contract. And what does that underwriting process look like? But before we get into that, we'll be right back after this brief commercial break.
Study the history of revolution, you find that many of the leaders of revolutions, political, economic, social, didn't believe that they were capable of bringing forth a new reality for their people.
A lot of people think that their money issues come from not having enough money. The issue that comes as it relates to supporting Black-owned businesses is the psychological trauma that is connected to how we spend our money.
I want everyone to realize that I think the new statistic is something like 50% of Black people do not own property. And that's actually worse than what it was a couple of decades ago, right? So we're actually declining when it comes to putting yourself in positions of wealth.
Without further ado, we want to reward one lucky vendor with our Black Wall Street grant. So I came up with this grant in order to pour back into our community and give one vendor a year the funds that they need to further their business and exemplify Black excellence. Welcome back. We are talking wealth today, specifically about the home buying process and what that looks like with Miss Amber Thompson, the mortgage loan originator. Amber, listen, the conversation that we've been having has been so influential, I know, to a lot of people who are in the home buying process or want to start and don't know where to start. So before we went to a commercial break, we were talking about, getting your credit profile together, your credit resume, making sure that you can get a pre-approval letter so that you can actually go through the process and get to the closing table when buying a home. So now that someone has gotten their credit together, they have their employment history, all of the things necessary in order to put an offer in on a house. What does the underwriting process look like, and what should they be prepared for?
So let me just tell you the difference between me and most loan originators. I underwrite my loans up front. So I cover all our bases and due diligence on the front end. So
Right.
all my realtors, and I work with a lot of realtors, when I send a pre-approval, they know my pre-approvals are solid. That's because we cover our bases up front. So the process goes like this. When you apply, I pull your credit. You send me your documents that I request, which are traditional documents, depending on the type of employment that you have. All right. Once I review it, look over your credit, I pre-approve you, send the pre-approval to your agent and to you. You go shopping for a home, right? You can shop up to that price point that I pre-approve you or under. Okay. You can go over it, but that's you spending your own money if you go over that pre-approval amount. Okay. Now, in most cases, I don't submit the loan to underwriting in advance unless my realtor wants me to, but because they know I'm thorough with my loans, it's not required. Right.
Okay.
But typically underwriting turn times can go anywhere from 1 day to 3 days. It just depends on their pipeline of loans. Okay. So once a contract comes in, your realtor sends me the contract. You and I, the buyer, I'll circle back to you. We have a conversation on the next phase because I do everything in milestones with my clients so that they can get educated as we're going along. Right. So once the contract comes back in, I review everything, just depending on how fast we got a contract, because some documents do expire like pay stubs.
Right.
It just depends. Right. But once I review everything, review the contract, at that point, it goes now to the next milestone, which would be into processing, and from processing to the underwriter. The underwriter window is 1 to 3 days. Typically, it's about a day to 2 days with me as far as coming out of underwriting. So once it comes out of underwriting, it's considered a conditional approval. Or if it's some issues, the underwriter will either hold the loan, not likely, but they can, or they'll send it back suspended. Okay. I rarely ever have a suspended loan, so I'm pretty much a conditional approval originator. So when it comes out of underwriting, we have conditions. Conditions are certain things that the underwriter needs to check out their list to clear. It can be something simple, like I'll give you just a small example. You sent the driver's license over and your picture was a little dark. The underwriter will see your pretty face, right? So the underwriter may condition for a lighter driver's license or bank statements. We need updated bank statements to show where you've paid your earnest money. You paid the appraisal fees. We want to show that there are sufficient funds in the account to pay for the closing costs. So those are conditions. Unless there are some other things that can arise that weren't made aware of on the front end, the underwriter will condition for it. Another thing that I wanted to touch on that a lot of people, so with credit, a lot of things no longer report on your credit. Some of the blemishes like judgments and liens, a lot of those things no longer report. Okay. I recently just had a client that was in a bankruptcy. He reaffirmed his debt. He didn't discharge the mortgage, but he reaffirmed it. But the mortgage company didn't report it on his credit. Right. So I knew that he had a mortgage when I saw tax returns. I saw Schedule E. The thing is, I question it on the front end because once I submit that loan, I know we have other systems in place that can pull things based off your EIN as well as your social.
Right.
Okay. And certain things will also show on title. So I just tell my clients, like, listen, I get it if you're working with a credit specialist and they tell you they can remove things off your credit. I'm not telling you they cannot. But don't be surprised if some things still come up.
Right.
Okay. Because there are systems in place that we do use for that reason. And they're getting more educated in using those systems because they know people find loopholes.
Listen,
right?
I'm so glad you brought that up because a lot of people think that they can pay somebody this lump sum of money to, hey, clean this off my credit so I can go buy this house. And then they're confused about, well, I thought they cleaned this up. Why is this still coming up? Let me tell y'all, scamming is not the way to go. Like, it's just not the way. Like, do it the right way. It can be done the right way, and the right way isn't hard. And you won't run into so many issues going into the process.
Or waste money.
Or waste money. Like, you got these people out here guaranteeing that they can clean things up, not knowing that there's people, businesses are learning the scams. That's what people aren't getting. Like, people are learning the scams. So you're wasting money just to turn around and have to do things the right way. Just do it the right way from the start.
And you know what else? I'm happy that you're speaking on that too. Don't get me wrong. There was a point in time where it did work, right? Where you could remove things off your credit, but you have to keep in mind, we're just now getting advanced to things that were happening decades ago. But
Right.
because we're getting educated on doing those things, something has to be put in place to stop it.
Right.
So what used to work 5, 7, 10 years ago, it's not as strong
Right.
as it used to be in today's world, right?
Right.
So as I stated, that's one of the things I wanted to touch on, with just bringing some awareness to that. But once the loan comes out of underwriting, the underwriting conditions the loan, my processor or my team will look at those conditions, reach out to the buyer, which would be you, and then they collect the remaining documents we need, submit the loan back to underwriting for final approval, right? Mm-hmm. And then once it goes through final approval and the underwriter clears the loan, that's it. You're clear to close. And believe me when I tell you, it can be just that simple. My clients have a seamless process when they work with me. It's really that simple. You know why? Because we do our due diligence on the front end. We cover all of our bases up front. I would never drag a client through this process just to turn around. They've lost earnest money. They've lost appraisal fees. These are fees and monies that you won't recoup. You're not getting that money back. Just to turn around and tell them the loan is dead. The only time something like that would ever happen more so with me is if something arises that you never made me aware of, and I didn't know that this could be a deal breaker, then that's a different scenario. But for the most part, when we cover our bases on the front end, the process is really seamless. I close my loans literally 1 to 2 weeks early. Right. That's how quick the process can be. But it's all a matter of educating your people up front, helping them understand what is needed on the front end in the same breath of me pre-approving you, so you know what expectations are set. Right. There's no guessing.
So you talk about the timeline. Like if somebody, what is the smallest timeline from start to finish, getting putting the offer in and closing? What does that length of time look like? How long?
I've closed the loan in 10 days.
Wow, so, that's really fast.
It is. Now,
but I personally when I bought my first house, we closed in 21. Like it was really, really quick. Once I put the offer in, gave them my documents, that was it.
They was like, hey, it was a done deal.
That was it, because you had, like, if you have everything in place, it's really that simple. Especially if there's nothing to hide. If you tell the truth, hey, this is what this is. Here's my pay stubs. Here's my profit and loss for my business. Here's my tax returns, and that's it.
Absolutely. And I mean, sometimes the hiccups that can come into play, because I don't want people to have a perception that everybody can close in 10, 14, 21 days, right? Because appraisals are a factor. So with my realtors, when they know a contract has been accepted and they give me the property address, I order the appraisal immediately. I order it before the loan gets submitted. So that's already en route, right? So it is contingent upon how fast the appraisal come back. That has a lot to do with it. But in most cases, as long as you structure the loan properly up front, you wean out all the issues. And that helps your client on the back end with security, knowing that they're good to go. Right. But it's a seamless process. It can really happen in a very short period of time. Like you can blink and you can have your keys. In an eye blink. It can
really Absolutely. So you talked about the appraisal, and this show is all about talking wealth. Talk to us about the appraisal and how home value and equity comes into play of building generational wealth through real estate. What does that look like?
So, I mean, what an appraisal does, they just go out and appraise the property. They're going to do comparables to the home that you're interested in, or if you're doing a refinance on your own home, it's to let you know how much equity is in that house. And if you're buying a house either undervalued, which likely you want to buy a house that has equity. So if you have a purchase contract for $400,000 and the house is worth $375,000, you have to go back to the drawing board with the seller. Are you willing to pay for a house that's over asking? Depending on, because you have multiple bids that come in. So that's what the appraisal is there for, to make sure that you understand how much this house is worth before you buy it. In addition to some of the other repairs, if it's things that need to be completed in the home, depending on the type of loan you have. FHA is a little bit more strategic on what they're looking for, safety issues. Conventional is more flexible. They don't necessarily care about a lot of those little ins and outs. But ultimately, the end goal is to make sure you buy a house with equity, right? And it also helps you see what homes are comparable to that property that you're looking to purchase. So in most cases, you'll have the appraisal, which is what I, the lender, will order, but your realtor also would recommend that you get an inspection done. Me as the lender and any lender in this industry, we don't care about the inspection, but it's good to have one so that you know the home is sound, right? You don't want to buy a house and the floor up underneath the foundation is cracked. How would you know that if you visually can't see it? Right? So there are two separate lanes when it comes to appraisal and inspection, but they're both very vital to have, right? So
I was gonna ask you about appraisal. Let's say the person isn't buying their first time home. Let's say they're trying to refinance. How does the appraisal play into that specific situation?
Yeah, absolutely. So you want the equity. So the equity there helps determine what's your next goal. What is the need? Everyone has a need for something. You're refinancing your home for a need. What is your need? Is it to debt consolidate? Is it to lower your mortgage payment? Typically, and I do a lot of refinances. I've been doing a lot of refinances in this market, and it's so surprising to people. But I tell all my clients that I refinance, if you focus on the rate, you won't see past the rate. The thing is,
you definitely say that. I've heard that myself. You definitely say it.
If you have enough equity in the home, then what's the need? What is your need, right? Do you need cash out? Are you just trying to do a rate in term, right? A rate in term is you don't want to take the equity out. You're just trying to lower your mortgage payment. What type of loan product do you have? Are you in an FHA loan or a conventional, right? If I put you in an FHA loan because that's what you qualify for once we start, and that's just what you qualify for, the end goal would be to switch you to a conventional loan. And don't get me wrong, both loan products are very good loan products, okay? But with conventional, depending on how much equity is in the home, I would lower your loan to value to 80%. So what that means, if you were buying a home right now and it was an FHA loan, okay? FHA, your 9 times out of 10, your loan to value is going to be 96.5 because you're having to put down 3.5%. That makes 100%. Okay. So that's on FHA. But if you're in a conventional loan and you're not putting down 20%, you're going to have PMI. Okay. So if I close you on an FHA loan, 9 times out of 10 will have you come back to refinance to go into a conventional loan so that now I can take your loan to value from that 96.5 to 80%.
Yep.
Okay. Wipe out the PMI, which that's a win for you because that lower your mortgage payment. You won't have that PMI payment. So what we're saying is now there's enough equity in the home that you don't have to carry PMI. Okay.
So for the people who don't know what PMI is, explain that a little bit.
Private mortgage insurance. So on FHA, you have MIP, mortgage insurance premium. On conventional, you have PMI, private mortgage insurance. That just basically means it's insurance for the investor in the event you default. So if you default on your loan, miss your mortgage payment, going to closure, foreclosure, they have enough equity or assurance in that property that they're not taking so much of a loss because you defaulted, right? So it covers them in the event that you default on the loan, okay? But FHA typically would stay on for the life of the loan, but lately FHA has trying to be a little bit more competitive with conventional, where if the home is like between 10, 13, 14 years of equity, it's starting to shave off. And it's not staying on, as far as the MIP, mortgage insurance premium, it's not staying on for the life of the loan. Whereas with conventional, once the home reaches that 20% in equity, it comes off, right? So when the home is like basically at 78% loan to value, it's usually 78% is what they tell you. But usually once you have that 20% in equity in the home, the PMI comes off the loan. It doesn't have to wait 30 years or whatever the long term is. So that's the difference. But that difference is the payment. That payment lowers, or when it falls out, it lowers your mortgage payment overall. That's a saving. So for me, if I have a client and I'm refinancing, the equity is a very big factor because it determines what we can do with your loan. If it's enough equity in there, you want to free up debt and wipe away majority, if not all your debt, or if you want to walk away with cash, right? You may have repairs you want to do on your home, as well as lower your monthly mortgage payment. So the equity in your home plays a very big factor when you are doing refinances. And even when you're doing a purchase, you will hope there's some equity in that home.
So one of the things I want our listeners to understand is by buying a home, how that plays into generational wealth is if you have equity in your home, or when your home gains equity, you can actually become your own bank because you have money sitting in your house. Like, it's there. You can just go get it. So I'm so glad that you brought that out. One of the things I want to talk about as well with this entire process is myths that you've heard that other people have brought back to you about this home buying process. But before we get into that, we're going to go to a quick commercial break. We'll be right back. Join us for the Black Wall Street Black Business Expo and create the change you want to see. All right, y'all, we're back talking wealth with Miss Amber Thompson, mortgage loan originator. Listen, if you have ever thought about buying a home, if you have a home and you're thinking about refinancing, or you just want to learn what's going on in the market right now, this is the conversation you want to tune into. So Amber, before we close out the show, I want to get into the myths regarding the home buying process and what's going on in the industry right now. Tell us about some of these myths so we can go ahead and bust these out so people can actually get some generational wealth through real estate.
So one of the biggest myths that I hear all the time, and I tell my realtors, if you have to use this as a selling point, you're going to struggle in this industry. The biggest myth is, I'm a first-time home buyer. What do I get? Nothing.
Not
it
a
just
thing.
means you have not owned a home in the last 3 years, people. It doesn't grant you any incentives. Now, being a first-time home buyer comes with other factors.
Mm-hmm.
If you're trying to get DPA, down payment assistance.
Mm-hmm.
So with down payment assistance, being a first-time home buyer is a requirement. Credit scores,
Mm-hmm.
income, location, dependents, all of those are equally aligned. You can't have one without the other, right? So when you hear people say, I'm a first-time home buyer, what do I get? Nothing. It just means you have not owned a home in the last 3 years.
I'm so glad you said that, because people...
I mean, it's a myth. And I mean, it's a selling point for people. They're like, oh, you're a first-time home buyer. I got a lender I can send you to. And then when people come to me, they're like, oh, I'm a first-time home buyer. And I'm like, okay. You haven't owned a home in the last 3 years. So again, you have to qualify. You know, if you're looking for down payment assistance, that's a different conversation. So I personally would tell my realtors no, for the most part. You know, don't use that as a selling tool. To me, it's misinterpretation to people. It's it'll have people thinking that they are entitled to receive something, and then I'm the one that's going to let them know that
you don't get anything.
You don't really get anything from just being a first-time home buyer. You still have to apply, and you have to, it's requirements for if you're trying to get into one of the programs, right? So for instance, Georgia Dream, that's a state program.
Yes, it is.
For the state of Georgia, right? If you don't qualify for Georgia Dream, and the reason I say that is because Georgia Dream has the highest income limit for a household. And it's broken out into different counties. Like you have Fulton County, you have Clayton County, Gwinnett County, Atlanta Invest, City of Atlanta. All of these places have their own DPA, down payment assistance programs, but their income limit requirements is not as high as Georgia Dream. So if you don't qualify for Georgia Dream, as far as if your income is too high, you would not fit in any of these county
other programs, right?
Because the income is a little bit more compressed. Right. So for instance, Georgia Dream income limits for one person, I think it's like under 85,000 for one person. So let's just say compare it to like Fulton County Hot or Fulton County or Clayton County. It's probably like maybe under 50,000 for one person. Right. And I use that so that people can understand when you're saying, hey, I'm a first time home buyer, what I get, you have to qualify for these programs. They have income requirements. They have dependent requirements, the location, all of those are factors in addition to you do have to be a first time home buyer. And you have to be within their income limits, right? So all of those are factors. And sometimes people don't read that fine print and that disclaimer. In order for that grant money, that bond money to be forgivable, you have to occupy that home as your primary residence for a length of time before that money is forgivable. A
Right.
lot of people don't understand that. So what that means to you as a buyer when you are going through these down payment assistance programs, if you refinance, you sell that home, if you do anything to change the terms or change the title documents, anything that changes the original terms, you have to pay them back that money.
Mm-hmm.
Now, whatever the amount is, it's not for me to disclose or have a conversation with you on, because I don't work for the down payment assistant company, right?
Mm-hmm.
That's something that you and the down payment assistant company would have to hash out on your own.
Right.
But I like for people to understand these things, or at least know that that is a part of their program requirements, so that you don't think, oh, I just got free money. Well, it will eventually be free after a length of time.
Right.
But if you separate the terms of this loan within their season period, you have to pay them back. Okay.
Right.
So most people don't know that that's a part of when you do receive down payment assistance money from these programs.
They got terms and conditions.
Absolutely. And it's not a bad thing, but I like for people to be aware so that you will know you're ready to refinance your house after owning it for a year. You come to refinance with me, but you don't have enough equity left over to pay them, but you're trying to free up your debt. Now you stuck in a pickle because they want their money first, and they're going to get their money first before anybody else get paid. Right. So, and even if you're selling a home, if you don't get what you want when you're selling a home, you know, it's one thing to walk away and break even, but who wants to sell a home and just walk away with nothing if they can help it? You want something, you know. But these are things I try to make sure people do understand. That's probably one of the biggest myths when you hear people say, I'm a first time home buyer. What I get? Nothing. It just means you haven't owned a home in the last 3 years. That's what that means. There's not too many other big myths. I think first time home buyer is probably the biggest one. I think that's really, I get that all. Well, I'll say this, another one, Credit Karma. My scores are higher on Credit Karma.
That's not even the same scorecard that you guys use. Like, a lot of people don't know that there's so many scores out there. So absolutely, your auto loan score is not going to be the same as your mortgage loan score. Like, all of that stuff is different. So Credit Karma is null and void when it comes to buying. And I tell people all the time, Credit Karma is null and void, period. For me, like, I don't even look at Credit Karma when I'm sitting with someone to advise them on what you can do to help make your credit better. Like, that's not the place you go. You need to go and pull your full credit report from somewhere like a
annual credit report.
Yeah. You want to get the real score. What has been in your 20 years? What has been the I would say the worst home buying story you've ever experienced in 20 years? Because I know you got some, because I've heard of some myself, and I haven't even been in the accounting industry that long, and I've seen some stuff.
When I tell you, oh my gosh. So I have a saying that I say, champagne tastes, beer budget. I'm not your yes loan officer. I'm your keeping it 100 with you. Right? I can't and I will not stretch somebody above their means. If you work with someone else and they can set you up to fail, is how I see it, then go for it. But it's the same scenarios. Well, I know my homegirl, or you know, a friend of mine or a parent, you know, their credit scores are not as strong as mine, and they bought a house without no issues, and
they're comparing again. Can't stand it.
And the thing is, and I make sure that my clients understand, listen, the more house you purchase, the more money I make. So if I can't qualify you for that price point you're looking to be in, it doesn't behoove me. I want all the blood. I want it all. I want all the coins.
Get all your coins.
I want it all. But again, I'm not going to set my people up to fail when I know. Again, I'm not here to tell you living above your means. I can only qualify you based on what you actually qualify for, right? And it's just one of those things. I've heard so many different type of stories that, I mean, some stories are sad, you know, because people have worked jobs for lengths of time and have been loyal to companies, and unfortunately they just don't make enough money. to be in the price point that they would love to be in. And in this demographic, in this market, the housing market is making it a little bit more difficult for people to purchase within a price point that used to be very conducive at one point in time. Like you were okay with buying a house for $175,000 or $200,000. Now it's like, where can you find a house for that price point?
I know that's real. I came in at the perfect time. Mine was 198.5. I came in with 1,500 equity. I was like, man, now the houses around here like 300,000 and up, and it's like
absolutely. And you know what else?
For me, because I got equity, but
absolutely,
I paid 300,000 for a house.
Absolutely. And another thing that's becoming more profound in this industry, I'm originally from Georgia. I'm an Atlanta girl from the city, from Atlanta, born and raised. And the funny thing is, a lot of the outskirt areas that were never like, these were areas that were considered country to us, or oh my God, that's far out. These places are becoming very profound now. They're coming on the map. You know what I mean? Because it's forcing people to move out further. Like there wasn't, Ellenwood and McDonough and Tucker and I'm trying to think some of the other counties like
Covington,
like all of those places were not on the map.
Right.
You know what I mean? But now you're being pushed to those areas because everything closer to the city in Metro Atlanta, most people can't afford it. You can't afford it. The property taxes are high. So it's like, in this industry, like I stated, it's just one of those things where I would love to pre-approve everybody if I could for over $300,000, $400,000, $100,000, right? But realistically, most of the demographic of people don't have the income to support that type of a mortgage and pay your current debts, right? The trade-off is I can have a client that don't make a whole lot of money, or what you consider a lot of money, right? Let's just say maybe $50,000 a year, but they may not have a lot of debt. And so I get those type of stories. I mean, I make good money. But you got like your debt to income ratio is super high. Yes, you may make the money, but how much of that money is paying debt?
Yep.
Absolutely. And so that's another thing with people just understanding that it's not so much that we as loan originators are trying to make you suffer and not pre-approve you for your price point, but I'm not going to put you in a pickle where I know I'll go ahead and send you a pre-approval and make you believe you can really buy this house, have you go through the whole process, go in under contract, submit it to the underwriter just for the underwriter to say, Amber.
No. No, ma'am.
You know this income is not supporting
you. Tried it.
Again, now you're out of your earnest money, you're out of appraisal money. I don't do that to people. So again, I make sure people understand I'm not here to lowball you, right? But realistically, if you're looking for someone to be a yes person to you, I'm not the go-to person for that. I'm going to tell you where you stand realistically in real time based off what you provide and the income that you produce. Another thing is I want to make sure people understand how income works, and I'll leave it at that. You have to have 2 years of employment history. Okay. You can move from one job to the next job, but if you do that, depending on if there's a gap in employment, okay, that's number one, if there's a gap. Secondly, if you work overtime, receive bonuses and commissions and all of that good stuff, if you switch jobs, you end that incentive, right? It works when you've been in that same company for 2 years because we're averaging that income. That's the incentive income, the overtime, the bonuses, and the commissions. So if you switch jobs and you're working all this overtime, good, because that's extra money you'll have to help with your closing costs. But you won't get or receive, typically in most cases, you won't receive that extra cushion. Now, in some cases, I can try to fight and get exceptions for clients, but I try to make sure people understand when you're working a job and you are receiving that income and you decide to leave, do not leave while you're going through this process. Okay? Because you'll lose that incentive income. You will. So a lot of people don't understand how that works because they're like, oh, I'm working all these hours, I'm getting the overtime, but we can't count it. Right. Because it has to be consistent. It has to be continuance. Right. Another thing, and I said I'll leave it on this, when you receive supplemental income, okay, if you're receiving child support or if you're receiving Social Security, the child has to be under or not near 18 years of age for that income to count. A lot of people don't know that. So if you have a child that's 16 and they'll be 18 within the next 3 years, so we know they'll be 19 and you're receiving child support or some type of Social Security, in most cases, depending on the disability, if there is a disability, But most of the income cannot be counted if the child is of age of 18 because it has to be continuous.
Right.
So these are things that people don't understand or know that I try to shed light on so that they
Right.
are aware. These are all factors when you're trying to get pre-approved for a higher dollar amount.
Right.
Okay?
So one thing I want you to touch on real quick before we close the show. Talk about the income portion when it comes to taxes, because I'm a CPA and a lot of people don't like hearing the stuff that we tell them about their taxes when they're going through the home buying process. So they'll be a little bit more receptive if it comes from somebody on the other side. What do you have to say about somebody's tax return and they're trying to buy a house?
Yeah, absolutely. So it depends on, for one, how you file. Where you file? Schedule C, the 1120s, K1s, S Corp, all of those are factors. But here's the thing. If you write everything off,
Thank you.
Okay, then we know there's no income. So you have to pick your poison.
Yes,
and
ma'am.
You either going to show income and owe Uncle Sam, or you're going to write everything off, break even, and show no income.
Or get a refund, because that's what they want.
Get a refund. But if you go any of those routes where you're getting a refund, you're writing everything off, you don't owe, likely that tells us you have no income. But
and
if you
kiss your home buying dreams goodbye.
Hey, unless you amend your taxes, and I'm not the one, you can't say I told you that. That's on you. What you do with your taxes is solely up to you. However, 9 times out of 10, if you know you are looking to buy a home within the year or 2 years and you are self-employed or you use taxes for whatever reason, make sure you get your taxes in order, because we're not looking at your gross income. I'm looking at your net profit and loss.
Absolutely.
Okay? I'm looking at your depletion, your depreciation, your miles, meals, all of those. Okay, meals are deductions, not a credit. So depletion, depreciations, and miles, credits to you. Meals is a deduction. So these are things that a lot of people are not aware of. And, they're looking at, I grossed a lot. We're not looking at gross. We're looking at your profit. What did you take home?
Right. I'm so
That's
glad
important.
You said it, because when it comes from us, we're the bad guys, but we're like, hey, we're working with these mortgage loan originators and with your realtors to help you close. And if you get a refund, ain't gonna be no closing, ain't gonna be no house at all. So and that's one of the reasons why I created within my firm the Hope Initiative, because we actually explain this to people. We're working on 3 facets of financial literacy in that program. We're looking at budgeting, we're looking at credit, and we're looking at your taxes. Those 3 things have to line up before we say, hey, you can go and buy a house now, or hey, mortgage loan officer, this person, they're ready. Their debt to income ratio is below what you need it to be. Their credit is at this certain score. They have this amount of money that available for a down payment, or whatever the case may be. That's the whole purpose of the program. So I'm glad you said it. So maybe somebody, people can hear it from the horse's mouth, if you will, that Absolutely. CPAs are out here trying to make you owe. You have to literally pick your goal. Do you want a refund, which is right now gratification, which is what our community struggles with, or do you want delayed gratification so that you can get your home? Absolutely. Thank you, Amber. Thank you for this conversation. I really appreciate you. Before we let you go, if people want to work with you, they want to get more information about your products, your services, and just connect with you in general, where can they find you?
Yeah, absolutely. I'm on Instagram at Amber, the Mortgage Lender Expert. And I wanted to say this too before I let you go. I only use tax returns if you're self-employed. If you're a W-2 salary, I don't use tax returns. If you're 1099 self-employed, I use tax returns. So just make sure, people understand that that's a difference. So everyone does not have to provide tax returns. Tax returns are only provided when you're self-employed. Okay. But my platforms, Instagram, I'm on Facebook as well as Amber Mortgage Lender. You can at me, or you can reach out to me at amber.thompson at Thrive Mortgage. You can contact me at my telephone number, 678-789-3006. I'm pretty well open. I work around the clock. I'm not a traditional person that works Monday through Friday, 9 to 5. I work Monday through Monday around the clock. I'm very accessible to my clients. I'm big more so on you contacting me via phone. I'm not so much, I'm on social media, but that's not my real go-to, because I like having real conversations with people. And some people, everybody's not on social media, right? But you can reach out to me. Like I stated, if you do reach out to me on social media, or even just with calling me, I'm very accessible to talking to clients. I don't want to say on and off the record, but just to get a picture of what you're doing.
Yes, absolutely.
So yeah, those are my platforms, but mainly I am on Instagram a little bit more nowadays. But ultimately, I'm accessible by phone. You can call me. You won't get a voicemail or a operator. You can reach me mobilely.
So listen, y'all, reach out to Amber if you're in the home buying process, you want to get in the home buying process, or you currently have a home and are looking to refinance. Whatever the case may be, reach out to Amber and just make sure you tell her Talk Wealthy to Me sent you. Listen, y'all, that's a wrap for today. Thank you for tuning in to another episode of Talk Wealthy to Me. I'm your host, your family CPA, and I'm wishing you love, peace, and generational wealth. Thank you for listening to this episode of Talk Wealthy to Me. Remember to subscribe to our YouTube channel, like, comment, and share.